A lot of people pose this question: what is the difference between socially responsible investing, ESG investing, abbreviation of environmental, social and governance, and impact investing? This is what Galileo Impact Stories is about today. We decided to talk about different kinds of investments. My name is Sergey, let's start. The meaning of modern investments is no longer just about financial returns. An increasing number of investors use their money to make a positive impact on society and the world. From 2016 till 2018, total growth of sustainable, responsible and impact investing together was more than 38%, rising from $9 trillion in 2016 to $12 trillion in 2018, according to the US Forum for Sustainable and Responsible Investments. SRI, ESG or sustainable investing and impact investing are financial industry terms often used by investors, social entrepreneurs and other professionals. It's oftentimes assumed or misunderstood that these terms are relative and have approximately the same meaning. However, there is a huge difference between them, which is very important to know. Socially responsible investing – it's where it's all started. To sleep better at night, investors began to exclude investments out of their investment scope according to specific ethical guidelines. The underlying motive could be religion, personal values or political beliefs. For example, an investor may wish to avoid any fund that invests in companies engaged in alcohol, tobacco and weapon production. The aim is to generate returns without violating own moral principles and social consciousness. Usually, negative SRI screens include often called as a do-no-harm approach, negative screening is a relatively passive strategy to ensure that an investment portfolio doesn't cause negative social outcomes. But the main intent in SRI is still to maximize financial returns. Thus, investment managers have a duty to make investment decisions in order to generate the highest rates of return. For some investors, the negative screening was not enough, and they started to choose investments based on positive contribution. Positive versus negative screening is a key difference between SRI and ESG investing, as they indicate an investor's level of activity in pursuing positive impact through investments. ESG refers to environmental, social and governance practices of an investment, and it is usually reflected in the financial performance. The integration of ESG factors is used to enhance traditional financial analysis by identifying potential risks and opportunities beyond technical valuations. While there is an overlay of social consciousness, the main objective of ESG evaluation remains financial performance. This table lists common ESG factors that are usually considered. Investments with good ESG scores have a potential to drive better returns, while those with poor ESG scores may lower returns. ESG primarily helps identify risks, uncover opportunities, and leads to a better understanding of why a company can perform well. This all gives an idea of where the company is heading in the long term, as opposed to the financial reports that show where it has been. It puts meaningful data to show how a company and the whole investment portfolio perform in the context of environmental, social and governance criteria. Going one more step further to impact investing. At the very core of impact investing is the aim to help businesses to accomplish a specific social and environmental mission for the benefit of our society and the environment. In impact investing, creating positive impact is at the first place, and this impact must be measured. What about financial return? Impact investors vary in their financial return expectations. While some impact investors seek competitive or market rate returns, others may be willing to accept below market rate returns in order to maximize impact. The growing impact investment market provides capital to support solutions to the world's most pressing challenges in sectors such as sustainable agriculture, affordable housing, accessible healthcare, education, clean technologies and financial services, among many others. Impact investing and 17 SDGs are interconnected. Nowadays, mostly all impact investing engaged companies are indicating their targeted sustainable development goals. On a global scale, impact investments under management were worth about $114 billion in May 2017. After only 2 years, in June 2019, the amount of money invested in projects with a social or environmental benefit has increased up to $502 billion, according to GENE. Survey forecasts that by 2025 the global impact investment market will be worth $2 trillion. Well, let's sum up the results briefly. Socially responsible investing involves investments based on specific ethical guidelines and use negative screening. ESG analyzes the company's environmental, social and governance practices. Impact investing looks to help businesses or organizations do something positive to benefit society alongside a financial return. That's all for today. Write in comments how you understand the difference between SRI, ESG and impact investing. And bye! Have a nice day!